Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast app, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 14 in our series for 2021, and today's date is Friday, May the 7th. First, I'll be talking to Michael Ohanessian, CEO of managed accounts platform Praemium, and I'll be talking to economist Nicholas Gruen about how we should reevaluate fiscal and monetary policy. But now, let's talk to Michael Ohanessian. Michael, tell us about Praemium. You guys started as an off-platform service, didn't you?
Yeah, that's right. I mean, we started in 2001. The technology actually came out of JB Weir, would you believe? There was a software guy, JB Weir, called Arthur Neomedes, who then set up his own shop in 2001. And it was a SaaS business, software as a service business. And the thing that Praemium did on the earliest days was it had data feeds with all the stockbrokers in the country. So if Leon was out there buying shares through a broker or online through a broker, those transactions would come to Praemium, and using optical character recognition in those days, this is before APIs, we could see the transactions, and from that alone, pretty much, we can construct what your portfolio is. We know what it's worth. We know what its unrealized capital gains are, what its realized gains are, whether you're within the 45-day rule or the 90-day rule, and what the franking credits are. All of that, our system would just automatically create, all because we get the transaction data and we construct your portfolios. That is what we started with, and that is why we are the best at corporate actions and tax and performance reporting. One of our greatest resources, one of our greatest strategic assets is that we have every corporate action on every listed company in Australia since 1985, because that's when Paul Keating introduced CGT. And it's not so much that we've got a database of all those things. We've actually configured all of those corporate actions on every Australian company into our system, such that if you wanted to find out what it meant when BHP did some complex thing 10 years ago, we can tell you what that is immediately because it's all configured into our system. It's completely automated. And because we service the last two international investment banks who still do wealth here, and that's Morgan Stanley and Credit Suisse in particular, we also do that exact same thing for about 5,000 international securities, all those American companies and European companies and so on. And again, with a database of all of their information, all the corporate actions automatically configured in the system. So that is how we started. And it's an unusual birth for a platform, because normally a platform starts off as having custody, a bit like a managed fund manager does. You gather assets, you bring them into your environment, you hold them, you own them, you trade them, you report on them, and they're all in one place. Praemium didn't start that way. Praemium did it the hard way. We did reporting across the industry. And then later on, we became a platform as well, more recently.
How many client assets are actually off platform these days?
So it depends on what you count. But if I had to think about what I think is the ultimate number, there's probably about 300,000 investor portfolios that we do the reporting on, whether we have custody or not custody. The vast majority are non-custody. Three of the four big banks, plus Morgan Stanley and Credit Suisse, all use this service, the reporting only service. And let me describe the Australia universe as Universe A and Universe B. Okay, I used to use CommSec. Okay?
Right. Yes. Very reliable.
Yes, but it's Universe B.
Yeah.
Because every year when I was on CommSec, I'd have to get all this information, give it to my tax account. We'd have to work out what the tax was. In 2007, I moved into Universe A, although I didn't know that was what I did. I started using E-Trade instead. Now, E-Trade has been it's now called ANZ Share Trading, but call it E-Trade. They have been a long-standing client of Praemium's. And the deal with E-Trade, and it's still true today with ANZ Share Trading, is if you're on that system, you automatically get a tax report from Praemium. So in 2007, for the first time, I got this report from a business called Praemium I'd never heard of, but I had a tax report. And instead of producing all this information and giving it to my accountant, I just gave him this tax report. And my accountant looked at it and said, "Oh, that's Praemium." And that was it. That was the end of my conversation. It told him everything he needed to know. And so all of the stockbrokers and people that use Praemium, Morgan Stanley, Credit Suisse, E-Trade or ANZ Share Trading, JB Weir, Canaccord, Shaw and Partners, they are in what I call Universe A, where by default, one of the things you get every year is a tax report for your investing side that is 100% right, even in the most complicated of circumstances. Even if the ATO issues a class ruling after the event, even if it's a stapled security, it doesn't matter how complicated it is, we are right all the time.
Now, there's a substantial amount of investments that are off platform, which would indicate that Australians are speculators. How easy are these portfolios to assess?
Yeah, look, and I think that's a big problem. So we conducted some research with a firm independently. And what we found on average, now it's a reasonably big survey, but it's not 100% accurate. But we found that from the survey, about 22% of wealth doesn't sit on a platform as people understand a platform, including ours. Okay. So to give you an example, when you put money into a term deposit, that's not a platform, that's sitting with the bank, right? If you buy some stocks on CommSec or E-Trade or through a broker, that's not on a platform by definition, right? You'll have a HIN, your money's sitting in a HIN. If you invest directly with a fund manager into his fund, that is off platform. So, but if I just take the stock part, it is part of the Aussie culture for people to speculate in stock markets. It always has been. Particularly more so in the older days, particularly mining startups, in Perth, right? And so it is part of our culture that we don't want to go and just put it on a platform. It's a nice, easy solution. Australians are all looking for that next Afterpay or whatever it might be, the next CS. And so that is why, and the problem with that, of course, is that any particular individual like myself, I might have money sitting in several term deposits across multiple banks. I might have money with 1 or 2 or 3 different stockbrokers. I may have invested in a fund somewhere. I may have some money sitting on a platform, right? And so the problem with it not being on platform is the opposite of what's good about platforms. With platforms, everything is in the one place, like a managed fund, right? It's one nomenclature in terms of the way things are thought of. It's one database structure. It's one trading system. It's one reporting system. It's all held together. Whereas if I had to work out, even for myself in non-custody, if I want to work out what I'm worth today, I have to go and check my term deposit, see what it's worth, go and see what the stocks are I bought on E-Trade. Maybe I've got some money sitting in a managed fund and you find out what the value of that fund is. If you think about the work that you would do, or how much is in my super account, how much is in my non-super account. And so that is why when we talk about it being off a platform, that is really painful. Now, if you're a financial advisor and you have 100 clients, all of them have, let's say, 80% of their money sitting on a platform, Praemium or MLC or BT or Macquarie Wrap, it doesn't really matter. The advisor knows that part's easy to report on, right? Because it's on a platform. But all these clients have some money sitting, in a term deposit, maybe with some stockbrokers. They've got some old stocks that they bought through multiple brokers. How does the advisor capture that information so they can reflect back to the investor what their actual wealth position is? That's an awful amount of work. Even if you had to do it for yourself, if your wife turned around to you today and said, Leon, what are we worth? Well, you just think about all the work you would have to do. And remember, you've got direct access to it. Imagine being a financial advisor. You've got to go to the investor, try and find out how to get information about those assets that they've got that don't sit on a platform. It's a lot of work. And that is why, and I think it is always part of our culture. We're always going to have people that are going to want to invest, obviously, in term deposits and managed funds, but most in particular stocks, not just listed stocks, by the way, but unlisted companies as well. In fact, I've myself bought into an unlisted company. Some former colleagues of mine are doing really well. And so that's even more complicated, trying to work out what that's worth, right? It's not even listed. There's no price.
So what opportunities does that offer Praemium?
So we've always had the reporting. What dawned upon us, and remember, we've been doing this since 2001. What dawned upon us back in 2017 was that a lot of so when we give them the software, they then have to operate the software, right? So they can see all the holdings, they can see the transactions, they can see how we're handling the corporate actions, we're valuing things, providing reporting. But for that to be correct and accurate, they've got to do some administration work that only they could do, which is to reconcile, to make sure that, yes, in fact, because our system will project how many shares in BHP you've got based on, let's say, 10 years of trading in BHP, right? But to make sure it's right, you have to compare that to what the registry says you actually have. They are the source of truth. So the admin work they have to do on top of what we already provide is just to check that it's right, to just check it with the source of truth, be it the registry, be it the bank, so you can see that, if you had a dividend, is that actually, in other words, if you have BHP and you're expecting you get a dividend, our system will predict what the dividend payment's going to be, right? But to be sure of it, the source of truth is to have a look at the client's bank account and make sure that that's the money that actually came in. That's the admin work that our clients have to do themselves to make our software to become 100% accurate, and therefore, investment grade, 100% right from a tax perspective. Back in 2017, we then started to realize that maybe we could do this for some of our clients, and it's just taken off. And in 3.5 years, we've gone from one client with a few portfolios to today, where we have a dozen or 15 firms who are now using this service, over 6,000 portfolios where we are doing all this administration, checking against the source of truth, the registry or the bank account. And it covers over $16 billion worth of assets. And so for those firms, we are taking away all of that pain of reconciliation and making sure it's right. We open the mail, we do all that work for them, and we're good at it, and we can do it at scale because we can do it across a number of firms. And we think that this is a game changer. We're still early in this process, but we think that the future potential is massive because every advice business out there has this pain, and it's inefficient for them. It's not a good use of their time and money, and it distracts them from what they need to be working on. And if we can take that pain away, because we are the best at operating our own software because we know it best, and we can do it at scale.
And of course, so because you started out as an off-platform business 20 years ago, It's in your DNA.
It's in our DNA, absolutely. And we can do this better than anybody. And we believe that, we're not trying to be the solution for everybody, but in terms of advice businesses, if you think about it, and a lot of our history actually has been simply this. A lot of particularly the small firms, there'll be some financial advisors, there'll be therefore an admin team and an advice business, as you can imagine. And they might have one person who becomes an expert user of our software and does all of that administration. But if that person leaves or goes on maternity leave, whatever it might be, suddenly they panic. And invariably, these firms, particularly the smaller ones, would either give up or they'd come to us and say, can you help us? We've just lost Melanie, who's our expert, and we don't know, no one else knows how to use it. So it's all about focus and expertise and sustainability, and outsourcing this admin work for off-platform assets is the obvious thing to do. And if you think about productivity in the history of humanity, it is all about greater specialization and outsourcing all those things that are not core. And this is the next frontier, particularly in this country where we will always have a lot of wealth off platform.
So that represents an enormous opportunity for other wealth management firms, doesn't it?
Massive. It's, one of our peers, NetWealth, actually was in the newspaper talking about how they wanted to go after this market, and they named it as a over $1 trillion market. Now, I don't know how big the market is, but it's pretty big if you think about it. If you think about just the amount of money people spend just with stockbrokers, that gives you a sense of just how big this market is.
Well, that's quite exciting for you, isn't it?
It's
quite
massive.
exciting for premium, isn't it?
Yeah, and all those people that are already in what I call Universe A,
Yeah.
like E-Trade and Shaw and Partners, they're already most of the way there. Now, some of those clients of ours have also asked us to go and do the admin as well, but at least they've had the good software. So they've had the opportunity to get it right.
Well, Michael, we'll be watching that with great interest. Thank you very much for your time.
Thank you, Leon. Good to talk to you.
Thank you.
And now let's talk to economist Nicholas Gruen.
Nicholas Gruen, how would you assess Joe Biden's stimulus plan?
I think in the circumstances, it's a risk that Joe Biden and the Democrats need to take in the United States. It's worth noting, however, that they're being pushed into taking large risks because they have to get this through Congress. So they have to make a guess about the way the economy will evolve over the next 2 or 3 years. They're likely only to be able to control Congress for the next 1 3/4 years. And so what I think is significant to point out here is that we're doing this the wrong way. We are, what's happening is we're being forced into making large guesses about the future, and we don't do that with monetary policy. With monetary policy, we have a mechanism for making sure that the policy fits the circumstances all the way through, and we adjust it every month. We probably shouldn't be doing that quite so much with fiscal policy, but that's what I highlighted in my Financial Times column, and something I've argued we can deal with. I've argued that for 25 years, and happy to outline it for you.
Well, how could we make monetary and fiscal policy better?
So let's leave monetary policy out of it for a minute and let's look at Joe Biden's situation. I think what we need to do is we need to look at what we've done with monetary policy and ask ourselves, how can we adapt that to fiscal policy? What we've done with monetary policy is we have an independent central bank, and that has a huge influence. It doesn't fully control interest rates, which, let's say, that's monetary policy, but it has a huge amount of, it basically sets the rates. And in Australia, for instance, it can be overruled by the government, but it never has been. So it's been a very powerful body, and that means that we can track monetary policy through time. Every month, the central bank comes to a view about how monetary policy should be set. If you think about fiscal policy, it's completely different. It's negotiated through the parliament. Now, it's critical that parliament is involved in the setting of tax and spending decisions. Those are political decisions. But I would argue that the relationship between spending and taxing, in other words, the budget deficit or surplus, that in itself is a macroeconomic policy instrument, whereas actual tax rates, who gets taxed how much, that's what parliamentarians should be focusing on. So if we can separate those two things out, and the way I've suggested that happen is that there be an act passed by Parliament which enables across the board tax rises and falls, then we end up with a fiscal policy instrument which is a bit like interest rates, and we can then think about how independently we want that managed. And then we've brought about a situation where fiscal policy is a lot more like monetary policy, a lot more independent, and therefore a lot more fit for purpose in helping to manage our economy.
That said, I mean, isn't the role of Congress or Parliament to actually approve changes to tax and spending?
So I think that's absolutely right. And my response to that is to make this distinction between the sort of basic distributional questions that are addressed by parliamentarians agreeing on a schedule of income tax, what level the GST is, whether they're going to spend more money on housing subsidies or the dole or health. Those are questions for Parliament. But if on top of all that system, which has to be determined in the medium term by political haggling, to be precise, I think we should be separating out this aspect of the budget surplus or deficit, and we should be targeting that, manipulating that, or changing that with across-the-board changes. So those across-the-board changes are built on whatever distributional decisions Parliament has already made. So that's the idea, to separate the fiscal policy as a taxing and spending instrument for all the purposes that fiscal policy has, with a macroeconomic instrument. And I think the arguments are very strong that would put us in a much better position to manage fiscal policy.
That said, I mean, you've been arguing for the last 25 years that there have to be changes in fiscal policy and monetary policy, and you seem to suggest now that it's become even more critical in the last 25 years.
Yeah, so I think that the last 25 years have shown us, one of the things they've shown us is that we're in a situation where we are now, where we have monetary policy, we have interest rates at zero, they're sitting at zero, they've been sitting at zero in the Northern Hemisphere countries for years and years, and they've only recently got there here. What that says to me is that we have for decades overused monetary policy to manage the economic cycle. Why have we done that? Because we can't use fiscal policy because it just turns into a political bun fight and everything gets mistimed. In other words, if a government thinks it wants to spend a lot of money, it has to haggle a lot of those things through the parliament, and that can delay things by months, or if you need to raise taxes, often years. So firstly, the situation we find ourselves in shows how much relying on monetary policy to manage the economy, only how much trouble we've got into. And the second thing I'd say is that right now, the pandemic stimuluses have been substantially funded from money printing. So there are two ways to fund a deficit. One is for the central bank to print lots of money, and the other is for government to borrow the money from the public. So we've printed a lot of money. Once governments start being able to effectively print money, and I've simplified some of the explanation there somewhat, but trust me, that's a reasonable description. Once governments are able to print money, alarm bells should be going off. There's nothing wrong with printing money, but there is something wrong with giving a government the ability to just spend money and have that money printed for it. And in that situation, we need more independence in fiscal policy of the kind that I've argued for.
Now, you have suggested something like a consolidated macroeconomic stability board.
So you've got to ask you a question, which is, if you set fiscal policy up in the way that I have, that I'm suggesting you have, who should be the independent advisor or manipulator of fiscal policy? And there are two ways to do it. One is having an independent fiscal board, but we already have an independent body that is very important in the running of macroeconomic policy. It's called the central bank, and it controls monetary policy or the interest rate. And so you can easily give the sorts of powers that I'm talking about to just direct at the central bank. If you did that, you should think of it not as just the central bank, but as essentially a body that is dealing with macroeconomic stability more widely across the range of both fiscal policy and monetary policy. I call that a macroeconomic stability board.
And so this body, have we had anything like this before?
Well, we've had central banks but we haven't had.
Well, we have a reserve bank which is independent. We have a Bank of England which is independent.
That's right. Sorry, you said we have a reserve bank that's independent, and what else that's independent?
The Bank of England is independent.
Yeah, that's right. Well, that's a central bank. Yes, that's right.
So central banks are, by legislation, are meant to be independent.
Correct.
So how would a macroeconomic stability board work with an independent central bank?
It would be the central bank. You would expand the remit of the central bank to have a role in fiscal policy.
Right. Okay.
Or, it depends how you do it. You can fold the central bank into the, this is like determining whether something is a purchase or a merger. You can describe it in two different ways. And you can set up a macroeconomic stability board and locate the central bank inside it.
That would give the Reserve Bank and all central banks a lot more power.
Well, yes, it would give them more power. In which case, don't have them separate. That's not something I think I care about very much, or that I think I've got anything very useful to say. What's important is that there is a degree of independence in fiscal policy and a degree of independence in monetary policy. Whether you integrate those two things or not is an interesting question. And
what I'm saying is any decision to set up a macroeconomic stability board would therefore be an intensely political decision.
Well, indeed. And if you think that that's more scary than having two separate ones, just have two separate ones. It's not something I'm going to fight about.
Okay. Well, Nicholas Gruen, thank you very much for your time.
Thanks a lot, Leon.
So what's happening in the news? Well, AOL and Yahoo is being sold again, this time to a private equity firm. Verizon will sell Verizon Media, which consists of a pioneering tech platform, to Apollo Global Management in a US $5 billion, or that's 6.5 billion Aussie, deal, giving up its digital media ambitions in the face of competition from Google and Facebook. Verizon said that it will keep a 10% stake in the new company, which will be called Yahoo. Yahoo, at the end of the last century, was a face of the internet, preceding the behemoth tech platforms to follow, such as Google and Facebook. And AOL was a portal, bringing almost everyone who logged on during the internet's earliest days. And the Reserve Bank of Australia has kept the official cash rate on hold at 0.1%. And Australia's housing boom is showing some signs of slowing as the rapid rise of past 6 months begins to constrain affordability and dampen demand. House prices rose at a slower pace in April, a month after hitting a 32-year high, but strong demand is expected to further drive the boom for at least another year. Nationwide dwelling values rose 1.8% in April, the slowest pace since January after last month's record rise, CoreLogic Inc. data released on Monday shows. Capital city prices also gained 1.8%, led by Darwin and Sydney, data show. Sydney home prices jumped by 2.4% last month. Melbourne prices climbed 1.3%, and in Brisbane, prices advanced 1.7%. By contrast, in March, Sydney home prices rebounded by 3.7%, and in Melbourne and Brisbane, prices climbed 2.4%. And surging investor lending, which rose at its fastest pace in almost 2 decades, has pushed Australia's booming residential market out of regulators' comfort zone and made macroprudential controls more likely, according to economists. New data showing home loan commitments to investor buyers jumped 12.7% from February, the fastest increase since July 2003, to a seasonally adjusted monthly total of $7.8 billion. And Netflix paid around $550,000 in tax in Australia, despite estimates it brought in more than $1 billion in revenue from its subscribers in 2020, who had little else to do during COVID-19 pandemic lockdowns than binge its television and movies. The US-based streaming giant is slowly increasing the amount of income tax it pays locally, coughing up $553,705 for the 2020 calendar year, up from $485,371 in 2019, which was on the increase from $341,793 paid in 2018. However, the company continues to use a corporate structure, allowing a Netherlands-based subsidiary to recognise Australian revenue, estimated to be between $700 million and $1.4 billion. Local subscribers are billed by the Netherlands-based entity, and the money is collected by Netflix Australia on behalf of Netflix International BV, with the local entity charging it a fee to provide those services. According to Australian Securities Investments Commission filings in 2020, Netflix reported an after-tax profit of $878,234 on revenue of $20.54 million. This was up on the $17.3 million in revenue and profit of $854,695 reported in 2019. The revenue was made up by the service fees paid by Netflix Australia's immediate parent company, Netherlands-based Netflix International BV, which paid $14.5 million to the local entity, up from $12.4 million in 2019. Netflix Australia's ultimate parent, US-based Netflix Inc., paid the local entity $5.9 million, up from $4.8 million in 2019. And Boston Consulting Group's original quote for its work reviewing Australia's post-operating structure was $1.38 million for less than 4 months of work, a Senate inquiry into former CEO Christine Holgate's departure has heard. Despite the taxpayers putting the bill, the report has never been released into the public domain. Managing Director and Senior Partner Miguel Carrasco will not reveal the profit margin the firm made on the work. And the New South Wales Government will look to develop manufacturing capacity for RNA-based vaccines and medicines. Facilities would be potentially online in the next 12 to 18 months. New South Wales Premier Gladys Berejiklian says this could include manufacturing COVID-19 vaccines, but will also include other vaccines, including RNA technology. She says it's about the medium to long term. And Australia's budget deficit this fiscal year will be 30 billion Australian dollars, narrower than the government's mid-year forecast as a surge to hiring and iron ore prices bolstered revenue, Deloitte Access Economics said. The underlying cash deficit in the 12 months through to June will be $167 billion, Deloitte said in a report released on Monday, compared with Treasury's December estimate of $197.7 billion. The budget shortfall will almost halve again in fiscal 2022 to $87 billion, it said. Australia's economy has recovered rapidly from the pandemic as early containment of COVID-19 boosted confidence and fiscal and monetary stimulus supported firms and households through the crisis. This helped fuel a surge in hiring, with unemployment falling to 5.6% in March from a peak of 7.5%, meaning increased tax revenue and fewer welfare payments. In addition, iron ore, Australia's largest export, last week approached all-time highs. Miners have been struggling to keep up with demand from Chinese steel mills as the world's second-largest economy accelerates. Looking further ahead, Deloitte forecasts underlying cash deficits of $56 billion in fiscal 2023 and $49 billion in fiscal 2024. That suggests that over the 4 years to fiscal 2024, the budget will be almost $100 billion better off, Deloitte estimated. And the federal budget will set aside money for the construction of a gas-fired power station in New South Wales, amid a growing view within government that it is more likely than not the taxpayer-funded project will go ahead, regardless of what the private sector decides. Because the power station would be built by the government-owned corporation Snowy Hydro Limited, it would be listed as a cash-for-asset transfer and have no impact on the budget bottom line, which is the same way the NBN is treated. Last year, when launching plans for his gas-led recovery, Prime Minister Scott Morrison gave the private sector until April 30, 2021 to file final investment plans for a power station to replace the capacity that could be lost when the AGL-operated Liddell coal-fired power station closed as scheduled in April 2023. If the private sector did not step up, the government would, Mr Morrison said, via a gas-fired plant in Kurri Kurri, generating between 350 megawatts and 650 megawatts. And Energy Australia has finally given the go-ahead for a new gas-fired plant to be built in New South Wales' Illawarra region. The Tallawarra B plant will be at least 300 megawatts and will come online in time for the summer after the closure of AGL Energy's Liddell coal plant in New South Wales, Energy Australia said on Tuesday. It will be able to use gas as well as green hydrogen, enabling it to be switched to carbon-free fuel when it is available. Tallawarra B will be Australia's first net zero emissions hydrogen and gas-ready power plant with direct carbon emissions from the project offset over its operational life. Energy Australia will offer to buy 200,000 kilograms of green hydrogen per year from 2025. And Australian businesses have been slugged with premium jumps of up to 30% to cover cyber attacks, according to a new report by insurance brokers Marsh. The rise has been fuelled by insurers pulling back from covering such costly information technology attacks and hits from ransomware, in which hackers demand a payment to end the damage. Businesses that have been hit by cyber attacks include Nine Entertainment, publisher of the Australian Financial Review, and logistics outfit Toll. Toll was hit with ransomware attempts while no demands were made to Nine, even though the cyber hit had hallmarks of ransomware. Marsh noted that businesses renewing their annual insurance in the first quarter of calendar 2021 had a 35% rise in cyber premiums in the United States, double the increase seen in the prior quarter and the largest increase since 2015. In Britain, it was 29%. Australian businesses had paid similar figures in the first quarter, and the trend was worsening this quarter. And furniture retailer Nick Scali said it expected net profit for the 12 months ending June to reach between $78 million and $80 million, compared with underlying net profit of $42.1 million in 2020. Retailers such as Nick Scali, Harvey Norman, JB Hi-Fi, Temple & Webster, Adairs and Beacon Lighting have benefited from a sales boom as consumers cocoon at home and redirect spending on travel and restaurants to furniture, homewares and appliances. And Westpac has told the market it is aware of a statement of claim where ASIC alleges insider trading related to interest rate hedging activity during the privatisation of Ausgrid, a transaction which Westpac worked on in 2016. The claim also alleges unconscionable conduct and non-compliance with its financial services licence. ASIC has commenced civil proceedings related to this in the federal court. And Westpac has reported better than expected first half cash profit as the economic recovery in Australia and New Zealand continues. The bank's revenue from ordinary activities rose 1% to $10.7 billion, while statutory net profit rose 189% to $3.44 billion. Cash earnings were up 256% to $3.54 billion, beating estimates for the $3.44 billion cash profit. Excluding notable items, cash earnings rose 60% to $3.82 billion. And ANZ has reported a more than doubling in first half cash profit to $2.98 billion and a better than expected dividend buoyed by its retail and commercial banking division and receding COVID-19 risks. And Solomon Lew's Premier Investments has bowed to pressure to repay $15.6 million in JobKeeper subsidies but faces new scrutiny amid claims it's receiving more than $100 million in wage support despite lifting earnings by 12% in 2020 and almost 90% in the first half of 2021. As well, Premier will not be followed by a number of other notable ASX-listed recipients, including Harvey Norman founder Gerry Harvey. In March, Premier Chairman Solomon Lew and Chief Executive Mark McInnes defied calls to pay back net JobKeeper subsidies of $15.6 million received in the January half, or the $69 million received last year. Mr Lew and Mr McInnes said the wage subsidies received in the first half would not be used to fund dividends or bonuses and would be quarantined to pay full-time and part-time staff stood down in future snap lockdowns. Premier said on Monday it used JobKeeper subsidies to pay staff stood down during snap lockdowns in Queensland and Western Australia in the past few months. However, higher sales had fully offset the cost of supporting staff teams through these lockdowns, and the JobKeeper subsidies were not required. However, Premier's backflip has not brought to an end of scrutiny over the retailers' use of JobKeeper subsidies. Andrew Leigh, the Shadow Assistant Minister for Treasury, said Premier may have received as much as $110 million over the first phase of the scheme, based on 6,500 Australian employees receiving $750 a week between March and September, and has demanded Premier repay the full amount. The wage subsidies, combined with the $52 million in rent relief and strong margin growth, helped boost Premier's retail earnings by 88.5% to $237.8 million in the January half. This followed a 12% increase in the underlying earnings in fiscal 2020. On Monday, Dr. Leigh wrote to the Australian Securities Investments Commission asking if it would force Premier to disclose the total JobKeeper support it received rather than just the net amount. And Indian Australian business leaders have warned of a serious risks of trade and diplomatic relations from draconian COVID-19 travel bans, as Scott Morrison faces a growing backlash over threats of hefty fines and jail time for returning citizens. On Monday, the Prime Minister said the likelihood of anyone being charged under biosecurity bans on travel from India were pretty much zero, but he defended the two-week measure as necessary to protect Australians from the raging pandemic. Australia-India Business Council Chairman Jim Varghese said the threat of fines of up to $66,000 and 5 years jail for returning citizens were likely to hurt the Australian-Indian community and bilateral business and trade. And taxpayers face being saddled with a near $500 million payout if a review recommends the Morrison government should tear up the 99-year lease between the Northern Territory and a private Chinese-owned company for the Port of Darwin. The port's owner, Lambridge, said though it would participate with the review if required, the $506 million deal had already been heavily scrutinised. While at the time the Defence Department did not raise any objections, the deal, done in 2015, has attracted criticism on national security grounds for handing control of a strategic asset to Chinese interests. During a visit to Darwin last week, Prime Minister Scott Morrison indicated the government could unravel the deal if Defence or National Security Agency changed their mind and felt it had security implications. And Virgin Australia sank to a $3.1 billion loss last financial year and remains saddled with $1.2 billion debt it carried into administration, according to filings with the corporate regulator, demonstrating for the first time the full scale of the airline's strike before it was rescued out of administration. The airline called in administrators from Deloitte in April 2020, and after a competitive bidding process was sold to US private equity firm Bain Capital when creditors approved a deed of company arrangement in September. The financial support for the 12 months to June 2020, which was filed to the Australian Securities Investments Commission a fortnight ago, but only published this week, shows nosediving revenue and depleted cash holdings. Revenue fell 20% to $44 billion during the period due to the pandemic, which forced airlines globally to ground their fleets and mothball networks as travel demand and activity faltered. Virgin also only had $740 million of cash to service over $5 billion of debt that was due within the next year or so. The airline called in administrators from Deloitte in April 2020, and after a competitive bidding process was sold to US private equity firm Bain Capital when creditors approved a deed of company arrangement in September. And Domino's Pizza Enterprises is taking advantage of the demise of rival food outlets to snap up sites to help meet its ambitious growth targets for new stores. Chief Executive Don Mage said Australia's largest pizza chain, which is aiming to open up a record 260 stores this year, was in talks to buy or take over the locations of bakeries and sushi bars that had gone bust during the pandemic. It's very fortunate some companies haven't had the privilege to trade, Mr Mage told the Macquarie Australia conference on Tuesday. And that's it for this week. And next week I'll be talking to Dr Sam Huppert, the CEO of Pro Medicus, the listed technology provider which helps large medical facilities store and transport large images. And I'll be talking to Rabobank economist Michael Every about what seems to be a recovery in the Chinese economy and the implications for Australia. In the meantime, you can catch me on Facebook, Twitter and LinkedIn. And if you want, leave a comment. Wishing you all a safe and healthy week, and looking forward to bringing you Talking Business next week.